Okay, welcome back. We have concluded session 5 and we are ready to begin with session 6, options for income. Now, in our last section, we actually looked at the difference between traditional asset allocation, where you throw all of your assets into one bucket and rely principally on diversification to protect you from downside risk. And in addition, we looked at an alternative, which was staging money for specific needs and over specific periods of time for specific purposes. Those include money for in-case events, that is to say emergencies, but we also looked at the way you can allocate money for income as opposed to money for increase. So today we're going to look at some of the options for income. Now that we've looked at an alternative way to ladder your investments over time, the next question is, which of those asset classes are most appropriate to generate income in both an effective and efficient manner? That will be the subject of our discussion in this session. How many of you are familiar with these bridges? Anyone recognize that? Where is that?
It goes to Mount Pleasant from Charleston.
Okay. Do you know what the bridge is called?
Isn't it the Roanoke? The
Ravenel.
Ravenel.
Charles Ravenel Bridge, otherwise known as the Cooper River Bridge, right? This new bridge actually is almost 19 stories in height off the water. And I'm sure if you've driven over it, you know how high it really is. But what if you were driving that bridge and you didn't have guardrails? How would you drive differently? What would your experience be like not having guardrails? Well, first of all, you would probably creep along. You would probably stay in the center of the road rather than staying in your lane. You would drive totally differently knowing that you don't have those guardrails. But when you have guardrails, you're able to drive the speed limit and drive without fear. So what we want to talk about now is how to construct guardrails in your bridge. Again, we talked about traditional strategies. We talked about this different approach here of staging your money for different periods of time for specific purposes. And we're talking about the approach on the right here. If you were to enjoy 100% return today on your money, let's say that you have $100,000 and tomorrow it's worth $200,000, how would your spending change if that money doubled in value? Would you double your spending? On the other hand, how would your spending change if you lost half of your portfolio value? So the way you answer those questions is really going to tell me whether you're more interested in the probability-based approach or the safety-first approach. So again, keeping in mind that we're trying to fill the gap, required income needs to be predictable. It needs to be sustainable for a period of time. Income cannot fluctuate in value. The best sources of required income are, again, these 4 asset classes. And all right, so return on investment really needs to be rethought. And what we're looking for here is not so much the greatest return on your investment as the best reliability of income. All right, the other thing that you're going to have to answer for yourself, and this is different for each of you, is how much money do you want to leave to your family after you're gone? Now, I asked that question to someone not too long ago, and they said that they wanted to make sure that the last check they wrote was a check to the undertaker, and they wanted that check to bounce. So I guess that answer is different for each of you. Now, I also can tell you a quick story about a woman who a number of years ago had come to my office, and she wanted to basically know if she had enough money to live on. Her husband had recently passed away. And so as I was trying to understand her situation and do an assessment, I asked her the question, how much money do you want to leave to your kids? And she looked at me with this this look of horror on her face, like, why would I even ask a question like that? And I was stunned by that. And I asked her, well, why do you act surprised by that? And she said, do you realize my husband was an attorney? And more specifically, he was a defense attorney. Do you know how many children or kids in our neighborhood my husband defended? And basically what she was saying was that a number of kids that had grown up in her neighborhood, which was an affluent area of town, was actually in Spartanburg, had been ruined by their money. And so I just thought that was kind of an interesting exchange. So, all right, so these are different asset classes we're going to look at. The question again is, which of these is most efficient for producing required income, for filling that gap? Curtain A, if you need $12,000 a year based on the dividend rate, that's going to require an asset of $480,000. Now, the good news is if you use that approach, then you're essentially not going to be touching the principal, so you can leave that money to your kids and your grandkids when you're gone. Door B is basically our bond fund, which would require an asset of just over $340,000. And again, those assets are going to be available to your family on death. Option C would be basically this asset class, which is some sort of annuity, which is going to cost you $200,000. And those assets may not be available to your family after you're gone. So those are the options you have. So let's look at, again, this idea of income payout rate. Now, this is actually from an article that I just clipped yesterday, and I'm going to attach this after the class. But this was actually a study that was done of various asset classes, and I can't cite the article right offhand now. I think it was Wall Street Journal or something. But basically, they were looking at the various asset classes and which would produce the highest payout rate. And as you can see here, Social Security is the most efficient, followed by a single premium immediate annuity, followed by some sort of deferred annuity. And then the fourth is systematic withdrawal plan of 4% with a 4% rule. And then there's an inflation annuity. And then there is a real estate investment trust with Vanguard. And then there is another, essentially another withdrawal plan, but you're, instead of withdrawing 4%, you're only going to withdraw 3.5% because we're in a low interest rate environment. So you can see the options that you have there. Now, this comes from an article in Kiplinger, and this is an adaptation of the food pyramid. Now, I'm sure you're familiar with the food pyramid, where at the top of the pyramid, if you're trying to watch your blood sugar, you're going to eat fewer meats, and at the bottom, what are the I guess fruits and vegetables are at the bottom, right? So you're going to eat more of those types of foods and less of the foods that are high in carbs and high in protein. But the idea here is how to allocate over periods of time. And so as you can see here, in years 1 through 5, they may incorporate some sort of annuities into the mix in the first 5 years, supplemented by bonds, and then over time, they're going to add to the mix in those later buckets for growth over time. You can see different asset classes. So again, you're staging the assets over time in various buckets for specific needs. And that's the difference. Now, what that does is basically protects you from that sequence of returns risk that you may be exposed to in early retirement. And I would say this, if you look at your own particular situation and you don't have a gap, you may have sufficient pension income and Social Security income to meet your required expenses, then the way you're going to approach this is going to be different than someone who maybe has a gap of $1,000 to $2,000 a month that you're going to need to fill with money from your various investment accounts. So again, it's all going to be subject to where you're getting your non-savings based income. So sources of safe, predictable income, again, cash or money under the mattress, annuities, bonds, dividend paying stocks. Let's talk first of all about dividend stocks. Has anyone received any notices here lately from some of your announcing dividend cuts. Has anyone noticed that going on inside your portfolio? Well, as a result of this latest market upheaval, a number of companies are actually cutting or suspending their dividends. So that's something to be aware of, and you may have been counting on that. Now, generally speaking, if you have a stock that, say, costs $100 a share, and that stock is paying a dividend rate of 2% or $2 a share a year, and then that stock decreases in value to $50 a share, but it continues to pay that dividend, you don't care necessarily what the share price is because you're still getting paid your income, right? But keep in mind that companies pay dividends out of corporate profits. It's just that they're paying out of their profits differently than, say, a company that's just paying everything out in capital gains. So if they're not earning a profit, then they're probably not going to continue paying a dividend. There's that. Now, cash certainly has a lot of advantages, and certainly safety is a huge advantage, and there is an argument to be made to have a certain amount of money in cash. And to be sure, you need to have money for those in-case type needs, say the roof leaks or you need a new car or something like that. You need money that you essentially have drive-up access to at your ATM. And actually, what I'm going to do is I'm going to share some ideas with this colleague, but not today. I'll share it after the class, and I will attach the link. A colleague of mine, Charlie Jewett, who actually lives on the other side of the country in San Diego, works as a financial advisor, and he shared some ideas that I thought would perhaps give you some additional places to put money that are not necessarily under the mattress. All right, so when it comes to predictable income, again, bonds. So I want to take a few minutes to talk about bonds and some of the strengths and weaknesses of those asset classes for generating predictable income. Now, a lot of people use bonds inside of their portfolio as a hedge because they're counter-correlated with equities. And so you may have a 60-40 portfolio or an 80-20 or a 20-80, which is generally considered the most conservative investment portfolio. That is to say, 80% of your money in bonds and 20% of your money in equities. However, there are certain things you need to be aware of when it comes to investing for bonds in terms of their risk. Because even though they pay a stated coupon rate over time, they're not without risk. How many of you know the difference between these two food products? What is this thing on the left versus the thing on the right? Well, the food on the left is obviously jelly, and the food on the right is Jell-O. Now, why do I say that? Because when you look at these two foods, they're actually very different. I guess in some ways they're snack foods, but they really only differ by one thing, and that is one letter. Jell-O is spelled with an O, jelly is spelled with a Y. But they are in fact two different food products. And the reason I say that is because there are bonds, and there are another entity out there which are bond funds. They are two very different entities. Now, advantages of bonds, like annuities, they pay a declared rate over a period of time. They certainly offer a level of principal protection. If you buy a bond, let's say that's a 10-year bond, and it's paying 3% for 10 years, that company is going to pay you that 3% coupon over that 10-year period. And then what happens at the end of that 10-year period? You get your money back, right? You get your par value back. Par value is simply the money that it cost you to buy that bond directly from the company. So let's say that bond sells for $1,000, and you buy a $1,000 bond. It pays you at 3%. At the end of that 10-year period, you're not only going to have received your interest, but you're also going to get your $1,000 back. So that is your safety net, is your maturity date. But there are also risks involved when it comes to bonds. Again, keep in mind, you're talking about credit risk, first of all, but there's this other thing which we call interest rate risk, which is a type of market risk. And I'm going to explain that to you in just a few moments, but there's also an opportunity cost. So again, there is an alternative to bonds. Bond funds, or that is to say bond mutual funds, are not bonds. They are a bond derivative, if you will. They're a combination of a lot of bonds that have been put together, but they differ in several important respects. First of all, they do not come with a maturity date. So they are open-ended. When you buy a mutual fund, you are entering into an open-ended fund. Anyone can get in and anyone can get out at any given time. It's not closed-ended. So they are, as a result, subject to interest rates in a low interest rate environment. And I'll explain that in just a moment. They also carry heavy redemption fees. Now, I had a conversation this morning with an investment banker who had worked for an investment bank in London. And I asked the question, I said, what you worked on the bond side of the house, where did you see, what risks did you see? And he basically pointed out, he said, this redemption risk is real. And he said that if most bond funds needed to redeem more than 5% of their positions, in other words, there would be a run on the bank, as it were, everyone is rushing for the exit, they would not be able to raise enough money to be able to pay those investors back. They would essentially have to freeze declare a bank holiday, if you will. And if you've been left inside, then too bad for you. But that's a very real risk. So if you own bond mutual funds, just keep in mind that if for some reason in the future those units start declining in value and people start bailing out, you run the risk of essentially taking huge hits in terms of your asset value. They do not come with surrender charges as such, but these penalties may be imposed by other investors other than you. And the way I liken this is, let's suppose for a moment that you are in a theater and you're watching a movie and suddenly someone smells smoke and yells fire. All of a sudden, everyone starts running for the exits. And so you're going to get hurt in one of two ways. Is you're either going to get trampled or you're going to die of smoke inhalation. And in a very similar fashion, that's a risk that you run inside of bond funds. All right, so again, beware the cheap knockoffs. Again, they do not come with a maturity date. When you buy bonds, you at least know, and I'm going to go ahead and mute everybody here because I'm getting a lot of feedback. Let's see here. Okay. All right, I went ahead and muted. So if you need to chime in, feel free to hit the chat thing and I'll unmute you. Basically, the big safety net with bonds is the maturity date. At least you know that with bonds you can get your principal back at the end of the period. So that is a safety net as such. But again, if you're in bond funds, you run the risk of heavy redemption penalties. All right, now this is important. This is very important. When you look at the history, and we touched on this last week, we talked about the history of interest rates going back to the Carter administration. And if you recall, during that period of time, interest rates were in the double-digit territory. You could get a CD paying 15%, but buying a house was like buying a house on a credit card. So those were very different times. We are officially in what is known as a zero interest rate environment or period, a ZIRP period. We had moved out of that in 2015 after the great financial global collapse of 2008. Now we've moved back into it after this global pandemic. So the question is, where do rates go from here? Well, they can only go one way, and that's back up. Now, when that happens, several basic things happen with the bond funds. If you have a yield, that is, your bond is paying a certain interest rate over time, there are actually two different things, the ways that that's expressed, as a current yield or yield to maturity. Now, if you have a bond fund, you have no such thing as a yield to maturity. All you have is current yield. So let's say that your bonds that you're invested in are paying 4% today, and interest rates start going back up, and all of a sudden the new bonds that are being issued by companies or by the Treasury or what have you are being introduced at 5%. Well, suddenly the bonds that you're holding at 4% are not going to be worth as much, simply because everyone else is getting a better deal. So if you try to go sell those bonds on the market, on the secondary market, you're going to get less. You're going to have to sell those bonds at a discount. So as a result, duration is just a tool to measure the price fluctuations that you could get for those bonds on the secondary market. And it's expressed as a number of years from the purchase date. So again, if you own, and I'll show you an example here, it will determine how the price of that particular bond will fluctuate over time. So as an example, again, here we go, as you can see par value, and you buy a bond that's paying 5%, and suddenly the bonds that are being issued are paying 6%, you're going to have to sell that bond at a discount in order to give the buyer essentially parity with the newer bonds that are being issued at a higher rate. Now, by the same token, if you own a bond that's paying 5% and the newer bonds are being issued at 4%, you could sell that bond at a premium. And so professional bond traders know that, and they can operate in those environments, whereas you or I just aren't that sophisticated, and so it can actually work against you. Now, here's an example of duration risk and how a bond manager would look at that. And so what they're looking at here is, what is the impact of a decline in interest rates of 2%? How would that impact the return of that particular bond portfolio versus an increase of, say, 2% here versus an increase of 3%. So that's just an example. Now, the way they manage that is by laddering bonds. You may have heard of a bond ladder, and all they're doing is they're laddering the maturities of those bonds, and they're managing that duration, and it looks something like this. So if you buy a bond portfolio, you may have a bond that matures in 4 years, 8 years, 12 years, and so on. And what they're doing there is they're essentially spreading that out so that when this bond expires, then you can buy it and reinvest in a rising interest rate environment, and so on. So that's the way they control that. Now, they also control market risk through this tool known as duration. It's really the risk meter inside of a bond portfolio, and it's used to determine the amount of volatility that that portfolio will be subject to. So as an example, let's say that you have a bond, and let me go back and just explain to you the difference between a maturity and a duration. Duration is basically defined as the length of time it takes for you to get your money back. Now, if you buy a 10-year bond and that bond is paying 3%, as in my example earlier, getting your money back is going to happen at a date earlier than 10 years because of the interest that you've earned. So it's a combination of the maturity date plus the interest that goes into that calculation. Now, you may also own a bond that could be called back if the company decides that they're going to buy that back at a certain point. So all of those factors go into determining how long the duration is. So as an example, if you have a portfolio with a duration of 5 and interest rates move up by 1%, that means that that portfolio could decline in value by 5%, and so on. So if your duration in your bonds is 10, then obviously for every 1% that interest rates move up, in a rising interest rate environment, that could result in a decline in the value of that portfolio by 10%. So you see how that works. So again, now on the secondary market, you can buy bonds at a premium or buy bonds at a discount. And depending on whether you're in a rising interest rate environment or a declining interest rate environment, then you're using different strategies to get there. So I'm not going to belabor that. But now one thing, and I'm just going to share this with you, it's not so that you can go out and do this, it's just to let you know that the professional bond managers are using different strategies to buy bonds or build portfolios on your behalf. I've had people say, well, I just go to a certain website and I'll just pick out bonds in that website that are paying a certain interest rate. Well, there are several problems with that. But what the professional managers will do is use what is called a cushion bond. That is a bond that can be called back at some time in the future by the company that's issuing it. But it also sells at a premium, but it also carries an interest rate that is above the stated market rates, the current market rates. And so as a result of that, professional managers know how to manage that risk, whereas you and I are just not that sophisticated. But cushion bonds can be especially suitable for you in a rising interest rate environment. And you don't want to see volatility inside of your fixed income portfolio. So if that's you, then you should look at a professional bond manager who can help you buy a cushion bond portfolio. So again, the way that they manage risk inside of those portfolios is going to differ depending on the environment we're in. Now, right now, we're in an environment where the interest rates are likely to go up. But if we were in a declining interest rate environment, then they would use a different strategy. They would actually buy longer term bonds. Now, this is just an example of buying a bond with a duration of 6.6 years versus a duration of 4.5 years. And as you can see here, for every 1% the interest rates decline, that's going to mean a difference right there of what, $31,000. So that's the way that bond managers win in a falling interest rate environment. But the likelihood that we will see that in our lifetime is probably going to be slim to none. We're not going to enjoy the same tailwinds in the market that we enjoyed over the past, really since 1970s. So what would that be, 40 years? We're in a different environment now. In addition, bond managers will use different strategies depending on whether the economy is strengthening or weakening. Would you say that we are in a strengthening economy now or a weakening? Well, I would venture to say right now we've hopefully hit the bottom and we'll see things improve in the near future. But when that happens, when we see things going south, and they're going to use different strategies to obtain a higher return. And one of those is called a barbell or a butterfly strategy. And what they will do here is they will buy a certain group of bonds that would perhaps be shorter in maturity. They're going to skip several years and then buy longer maturity bonds out here. So 60% of these portfolios in this particular portfolio are going to be inside of 7 years, but then they have these much longer maturity. Why is that? Well, simply because they're waiting for the possibility that in this period, interest rates could have risen. So these shorter term securities, they'll redeem those and then they'll buy in right here. So it's just a way to essentially leapfrog and get a higher return over time. Now, sometimes what they will do is they will add what we call sweeteners to a bond portfolio to give it a little more kick. Just like you go down to the auto parts store and you buy gas treatment, Pennzoil gas treatment or whatever. You put it in your gas tank and it ups the octane of your gas and cleans out your engine. It gives you a little bit better performance. Professional bond managers do the same thing. Now, this is also very important. And what I want to talk about now is credit risk and why this is so important. It's the difference between essentially the yield on a treasury note and what you would get on a comparable or on a corporate bond. So let's say right now that the 10-year Treasury is just paying somewhere around 0.7%. But corporate treasuries are paying 2.7%. Well, the difference between 2.7 and 0.7 is 2 percentage points. That's the spread. And that's the difference that they're paying you in interest, because government bonds are considered risk-free, whereas corporate bonds, you're incurring some credit risk in the event that that company goes belly up. So this is just an example, again, of where the economy may be either entering into a, a growth mode or into a recession mode. So where do you suppose in this scheme of things, if the professional bond managers are changing their allocation, if they know that the economy is reaching a peak, when would they begin changing to more conservative and more or safer bonds? Well, actually, you would suppose that it would be right here at number 3, but in fact, the professionals will be able to determine that we're nearing a peak, and so they're going to begin reallocating their portfolios right here. And by the same token, if they see that we're near the bottom of the economy and things are about to start moving up, they're going to start changing their allocation, taking on more credit risk here in anticipation that the market is going to be changing. So this is just an example of that. All right, so this is, again, an example of a portfolio which is made up of higher quality bonds, and that's going to be something that's considered more conservative. It's not going to pay as much, but in a period that we're in right now, where there is a higher risk of defaults and bankruptcies by companies, then the smart money is going to be reallocating into these types of portfolios. And by the same token, in a rising economic environment, they're going to be reallocating into more corporate bonds where they can obtain higher interest rates over time. Now, this is very important because we're going to get down to the brass tacks of investing in bonds versus bond funds. Rules of thumb, first of all, is you need to be diversified, no more than 5% in any given position. So if you own individual bonds, how many bonds would you have in your portfolio if any one particular bond was no more than 5%? You would have to own 20 bonds in a portfolio to represent a diversified portfolio. However, it's also important to remember, and again, this 5% rule, if any one company inside of that portfolio, let's say, goes belly up and they're no longer able to pay you, or it loses 20% of its value, then the overall portfolio is going to only decline by 1%. And that's what that diversification is going to do. However, it's also important to remember that when it comes to the secondary market, that bond traders will never buy less than $25,000 per position. So that means that 25 bonds in any particular company. So the long and the short of it is, and this is like a dining room table, the reason they do that is because that's what they call an even lot. They don't just go out and buy and sell individual bonds. They buy and sell tranches of bonds. And it's much like going out and buying a dining room table set. Now, you buy a dining room table, and then you also buy chairs that go with that. You would never go out and buy a dining room table with just 5 chairs. That would be considered an incomplete set. You're either going to buy a set with 6 chairs or 8 chairs, but buying a set with an odd number of chairs would devalue that dining room set. And the same is true in the bond world. So the long and the short of it is, when you look at these rules of thumb, and really in order to buy a properly diversified bond portfolio and not just a bond fund, you're going to need about $500,000 to do that. All right, let's switch to annuities. Annuities are simply contracts that are issued by insurance companies, And they basically enable you to generate a level of income over time. The reason that people buy annuities is just the opposite of the reason that people buy life insurance. When you're buying life insurance, what is it you're trying to do? You're trying to protect your family in the event that you die prematurely. On the other hand, insurance companies are experts at managing risk, and so annuities are sold in order to protect you from something else. And that risk is the risk of living too long. So that's where insurance companies are basically able to bring the law of large numbers to the table and provide value to clients. So they are essentially like personal pension plans. They enable you to obtain income in a more efficient manner over time. Now, unlike bonds, and there is no secondary market for annuities, and so you have to be aware of some of the limitations of annuities, and I'll speak to that in just a moment. But generally speaking, they provide the opportunity for a guaranteed income for a stated period of time. Generally, that is a lifetime income, although you can buy annuities and you can invoke the clauses of the contract which will enable you to enjoy a stated income over a 5-year, 10-year, 15-year period, or what have you. But generally speaking, they provide an option for a guaranteed lifetime income. They're designed to protect you from longevity and as well as sequence of returns and inflation risk. I'll speak to that in just a moment. They're not designed to provide the highest rate of return, but they are designed to maximize predictable, that is, reliable, sustainable lifetime income. And the reason that is because it's not necessarily the rate of return that determines the amount of income you can enjoy. And keep in mind, we're talking about the multiplier and the multiple can. I liken this to a car that I purchased for my wife a number of years ago. I bought her a little, quote, sports car, and it was a Saab. Of course, they don't make Saabs here in the US anymore. But that vehicle came with an engine that was, I think, 2 liters. It was a small engine. And you're thinking, well, how is that car going to go fast with a 2-liter engine? Well, that car contained one additional element under the hood that made it go fast, and that was basically a turbocharger inside of the engine. What that turbo would do was pour additional gas into the engine, enable it to go really fast. So annuities are essentially like that. They are designed to give you a little extra speed, if you will, by virtue of some of these additional features inside of their contracts, but not by virtue of just the interest rates that they earn alone. One of the big drawbacks with annuities is that they are not really efficient when it comes to using for estate value. So if you have a portfolio and you want to use that portfolio for something other than income, maybe you have an IRA or something and you don't intend to touch it, then an annuity would not be a good fit because they don't enjoy a step up in basis. Now, I have to qualify that by saying that if you have an IRA, you don't have a basis. You don't have a tax basis on that asset. There is a 0 tax basis, and so it wouldn't make a difference. But if you own non-qualified money that you intended to leave to the grandkids, then an annuity would not be a good choice for you. The other problem with annuities is they provide limited liquidity. Now, annuities are considered long-term contracts with insurance companies, and their surrender periods vary. They often range anywhere from as little as a year up to 10 or 15, sometimes 20 years, which is ridiculously long as far as I'm concerned. They provide limited liquidity, but generally speaking, most contracts provide the ability to obtain free partial withdrawals of up to 10% of the accumulation value in any given year. So they do allow you to tap into that money. You're not having to wait until the end of that surrender period before you can actually access the money. Unlike the banks, where the banks are considered a fractional reserve system, insurance companies are required to keep more than 100% of their liabilities as deposits in reserves. So generally speaking, if you have an annuity insurance company, they're going to be required to keep $1.05 for every dollar in annuity liabilities that they hold in the books, or at least something like that. So they are, even though they're treated differently than banks, they still are required to keep a certain amount of reserves as a protection to the client. And they're subject to a lot of different rules and regulations by both the states and by the feds. So again, these things are designed to protect the consumer, to ensure that you're not separated from your money. There are different types of these products. There are income annuities versus deferred. There are fixed versus variable annuities. And there are fixed versus fixed indexed annuities. And we're going to speak to that in just a moment. I'll show you some examples of what these things could do. All right, you may have heard of some of the detractors of annuities. This is one of the more popular, Ken Fisher. I'm sure you've heard his ads. I had annuities and you should too. But realize that people like this are also selling you products. So oftentimes what I ask someone is, when you've heard a critic, then ask the first question you should ask is, well, what is that person selling? What is Ken Fisher selling? He's selling mutual funds. He's selling his portfolios. And so he has a vested interest in his point of view. It's also interesting to me, though, that he actually owns about a 10% share in a major annuity insurance company in the US. So he at least believes in them enough that he's invested in that company. Ken Fisher also has his critics, and Moshe Milevsky is another one of the thought leaders in our industry. He is actually a professor of finance with Troy University in Toronto, and he, I think, offers a more balanced view of what these products can do. And what he suggests is there is an ingredient inside of annuity products that cannot be replicated by any other retirement products, and anything other than Social Security. Common criticism: they're too expensive. They carry huge surrender fees. They do not provide added tax benefits on qualified accounts. They're taxed as ordinary income, not capital gains. They require you to give up your principal. They don't perform as well as equities over time. They don't include dividend growth, subject to frequent complaints, only sold for huge commissions. So I'm going to speak to those in just a moment here so we can at least have a better understanding. When it comes to deferred annuities, you have to remember there are different periods inside of an annuity. One is called the accumulation period, and the other is the distribution phase of the annuity. Now, the accumulation period is the period in which you can take free withdrawals. But if at some point you choose to invoke either an optional rider on the contract, which provides some sort of stated retirement income, or, quote, annuitize the contract, then you've moved from the accumulation phase to the distribution phase. So again, they all come with surrender periods. That's one of the biggest criticisms. And they have various ways of crediting your money and various types of withdrawals. Partial free withdrawals that you can take during the accumulation period, annuitization, which I would generally not recommend. There are very few situations where I could recommend someone annuitize their contract. But there are also optional guarantees that some of these contracts provide for lifetime withdrawals, which do not require you to annuitize the contract. So, why annuities versus other options for required income? Again, if you have a significant gap that you need to fill to meet those required income needs, an annuity may provide that in a more efficient way, a way to squeeze more juice out of the lemon. If you like the idea of predictable paycheck income rather than having to continually manage your portfolio over time, and again, it depends on your style. If you're someone who likes to get under the hood and tinker versus someone who just wants to enjoy life and receive regular paychecks, then that's a decision you have to make. If you are a more risk-averse conservative investor, then certainly this represents a better option than just taking the probability approach to retirement income. And if you're concerned about outliving your savings, it may make sense to look at that for part of your portfolio to at least provide an income stream to meet those ongoing bills. And if you're not swinging for the fences, if you're more content with base hits, then an annuity may give you the type of returns you're seeking. And again, if you're not always having to check the weather to see if it's safe to go outside, then certainly an annuity enables you to provide some sort of weatherproofing for your portfolio. And finally, if you have limited savings. Now, what I mean by that again is that if you're a constrained investor, you are required to take, let's say, 4% of your portfolio in any given year to pay your light bills, then you probably need to look at something like that to provide a more efficient source of income than, say, someone who has enough in savings that you're not required to take money out, or you're only required to take a very small percentage out, some sort of fixed annuity. Now, I want to speak to this other criticism, which is basically the expense. And in this particular example, this is an analysis that I had run on an annuity, which is a variable annuity, which again is essentially a mutual fund with an insurance wrapper. And variable annuities tend to be very expensive, and this is a perfect example of that. If you notice here, there are base contract charges, and each one of these variable annuities comes with what's called a mortality and expense charge of 1.2%, which essentially provides a guaranteed death benefit. It's probably the most expensive life insurance you'll ever buy, but that expense is 1.2%. In addition, they have optional rider fees of 1.15%, and the third category is they have sub-account fees. Now, these are the investment portfolio fees, and that totals almost 1%. So the total fees on this particular portfolio are 3.3% a year. I've seen some of these annuities where the expenses are as high as 4% a year. That's outrageous. So yes, this is a very valid criticism when it comes to certain annuity products. And as you can see right here, I'm trying to see what the actual annuity value, okay, $127,000. So that person would be invoked charges of almost $4,300 a year just to own this contract. That's a very expensive contract. Put another way, if this is what they own and their fees are around 3.3%, they would not see any earnings until they cleared about 4% a year in earnings in their contract. Now, if they had a year where they experienced no earnings inside of their contract, or even losses in their sub-accounts, then they're going to see a loss just because of the expenses that are embedded in that contract. So the hurdle rate that's required to actually begin earning money is actually very high in these contracts. And as you can see here, when you compare an option, an annuity option with no fees that's paying 3%, or perhaps a CD paying 3%, the only variable annuity that wins in this game is someone who is earning a 7% return. So this annuity that has earned 7% has outshined this fixed product earning 3%. So that should give you, I guess, pause when you think about purchasing some sort of variable annuity. All right, now, annuities are taxed at ordinary income rates. This is one of the other criticisms of annuities versus money that you have invested in a non-qualified mutual fund portfolio. So just keep in mind that that is the case. Now, the interest that is credited inside of an annuity contract, if it's a non-qualified contract, that is, it's not an IRA or one of those types of vehicles, is not taxed until money is actually taken out of the contract. It's tax deferred. So the earnings inside of a non-qualified annuity are taxed exactly the way earnings on a bond portfolio would be taxed at ordinary interest rates. Again, this is just a criticism of single premium immediate annuities that you often hear people say they require you to give up your principal. That's only true of these immediate annuities. That does not apply to deferred annuities. They don't, this is another criticism, they don't perform as well as equities over time. They don't include dividend growth. And that is certainly true of variable annuities. It's also true of fixed indexed annuities, but that's not really the reason why people are purchasing annuities. The reason why they purchase annuities is because they would like a certain degree of contractual guarantee and principal protection in retirement, as well as some sort of guaranteed lifetime income. So one of the other complaints that you hear oftentimes is that they're subject to frequent complaints. That really is only applicable to variable annuities. Most other types of fixed or fixed index annuities are not really subject to those kinds of complaints. One of the questions or one of the criticisms common is that they are very complicated. And whenever you read popular media, that's one of the first things they'll tell you is they're very complicated. And I would say, compared to what? Now, if you ever read the prospectus for a mutual fund portfolio, that's what I call complicated. I mean, those things can run into the hundreds of pages. And I venture to say that no one really reads those things to begin with. But to be sure, there are different moving parts. Some products are more complicated than others, but I don't really put a lot of stock in this criticism. Another popular criticism is they're only sold for their higher commissions. I would just tell you that if you look at the way annuities are sold, they are insurance products, and so they are sold on commission basis for the most part, and those commissions will vary somewhere between 2 and 7% of the purchase price. Now, the good thing is that money does not come out of your principal. It's only paid in the form of a surrender period. So what the insurance company is doing is they're paying the sales guy a commission, and most of the commissions nowadays are in the 5 to 6% range for, say, a 10-year contract. But what they're doing is they're saying, okay, we're not going to take this money out of your principal like would be the case if you bought a mutual fund with a front-end load, but we're going to ask that you stick around because we're going to go out and buy long-term bonds to underwrite a lot of the guarantees on this. And so in exchange for that, the charges that you are paying essentially are only going to be imposed if you violate the terms of the contract and bail out early. On the other hand, if you are working with an investment advisor who is maybe charging you annual fees for managing that portfolio, those fees can vary anywhere from 1 to 1.5% a year. So as an example, let's say that you purchased an annuity on the one hand, and on the other hand, you purchased a portfolio from an investment advisor, and each of those contracts grows by about 7% over a 10-year period. So they grow from $100,000 a year to $200,000. How much would you have paid in each of those scenarios? Well, assuming a 7% commission, that annuity agent is going to earn 7%. On the other hand, the broker, and I just, for some reason, lost that. I'll have to go back and see if I can find that. Okay, a broker over that same period of time will have earned over $15,000. So even though the broker or the investment advisor earns fees on that, they're going to be much higher, and those fees are going to be taken out of your account statement. So just keep that in mind. All right, so fixed indexed annuities, again, are a hybrid. I said they started in year 2000. They actually started a little bit earlier than that, but they're only meant to bridge the gap between bonds and equities. They're meant to outperform bonds and serve as a surrogate for bonds inside of a portfolio, but they're not meant to outperform equities over time. On the other hand, they are meant to provide lower volatility than equities over time. So they offer a number of guarantees. There are different types of guarantees for different products, and I'll show you in just a moment what that looks like. This is an example of a typical crediting strategy for a fixed indexed annuity. And just to give you a quick explanation of how they work versus investing in a variable annuity or investing in a mutual fund, what the insurance company will do is they will take, let's say, 97 cents on the dollar that you give them in premium, and they will go out and buy a corporate bond portfolio or some sort of bond portfolio that's a mix of corporates and treasuries. That bond portfolio will pay a stated interest, but they'll take the remaining 3 cents that you have given them from that dollar or premium, and they will go out and buy an options contract. Now, I don't know if you're familiar with that, but they'll take that option, and if that option is worth its value a year from now, or whenever the end of that option period when it expires, then any interest that's earned gets passed along to you as a consumer. So in this example, as you can see here, this particular crediting strategy is what they call a par rate strategy. And what they're allowing you to do is to participate in 40% of the index interest credit. So in this example, the index that they purchased was an index on the S&P 500. Now in that particular year, the index credited 35%. In this particular contract, the owner of the contract only enjoyed a 14% interest credit. So they're giving up some of the potential upside in the market. However, if you look in years when the market has taken a tumble, specifically looking at 2001 through 2003 period, where you can see that the market declined in those 3 respective years, this particular product credited no interest to the owner of the contract, but the interest and the principal were protected during this period of time. So that particular purchaser experienced no losses in the contract during that period. Any previous gains in the contract have been preserved, and that becomes your new protected value. And so, and then in the following year, in 2004, this particular contract earned 8.7%, and this person saw an interest credit, but they did not experience the full market recovery during that period. So over time, and I don't think you can see it as well in this particular graphic, that contract would have earned right around 4.5%. This is another crediting strategy, and you can see the same time period. This person earned about 5.4% over that period of time, between 1996 and 2012. Now, what I'm going to show you next is some examples of contracts that I've observed over the years to show you how they perform over a specific period of time. And this is a contract from a client who purchased this in 2016. Okay, the initial premiums here were, let's see, $260,000, almost $261,000. But they've taken free withdrawals of almost $80,000 during that period of time. So their net premium here would have been $182,000, essentially. And in this given year, 2017, between the anniversary date here and this period, this person has enjoyed an interest credit of 21%, which was, let's see, what would that have been? 9.4% that particular year. So that particular person has enjoyed an average earning of about 5.6, and that's pretty typical for these particular contracts. This is another example of another annuity, and this particular starting place here was $250,000. That person has withdrawn $71,000 roughly. So their actual net premium would have been about $180,000. And this past year, during that same period, that person would have enjoyed an interest credit of 13%. And there are 2 different indices that we use. Now, the one index that we chose, you can choose a number of different types of indices. But this one index earned over 21% that particular year. Had we put all of her, allocated all of her money to that one index, her credits would have been much higher. So she's enjoyed an average of about 4% a year. This actually is from a statement. The anniversary was April 13th of this year. The reason I wanted to show this example is because this particular client earned 4.7% a year since the purchase of this contract. They spent $133,000. They have not taken any withdrawals thus far. But in this year, they earned 5.2%. Now, the reason I share that with you is that this incorporates the period of March when we saw the market decline by as much as 35%. So during the same period when a lot of people had been losing money, this person enjoyed an average interest credit, or that particular year, an interest credit of 5.2% with no market risk. This is another example. Now, this person's anniversary was January 22nd, so it was before the COVID pandemic. But as you can see here, this person enjoyed an interest credit of 17.7% for a total of $29,000 on their contract. But they experienced no losses after that. So when the market began melting down in March, now in January of next year, they may experience no interest credits, but they will have not lost any money from this contract. In addition to that, there is that turbocharger that I mentioned under the hood that makes these particular instruments work particularly well. And that's expressed in this payout percentage. Now, if you recall, income is derived from two different numbers. The first is the multiplier, and the second is the multiplicand. The multiplicand is your portfolio value, but the multiplier is as important, if not more so. So this particular person earned a contract. They started out at age 63, and in the 4 years that they've owned this contract, they have seen the payout percentage increase, so that depending on the option they choose for income, this is actually an income option that allows their income amount to increase every year for the rest of their life, or they can take a higher flat payout. But if they turned on the income benefit here, their income amount would be 7% of their portfolio versus 4% for a typical retiree. So again, that is a way to earn more in terms of income for that required income need. Now, what I'd like to do in finishing our discussion of annuities for income is to look finally at one additional feature, which is known as the annual reset or ratcheting feature with a lot of annuity contracts. And we're going to look at a hypothetical example to show you how it could work in your favor over time. Let's suppose in the first year, your index that you've allocated for your money is at 1,000, starts at 1,000. And over the course of the year, it grows to 1,100. That represents a 100-point gain, or a 10% gain in the value of your contract. So you enjoy a 10% growth to your accumulation value. However, in year 2, your starting place is 1,000 on the index, but it declines in value. So now your ending point is 800. What happened to your account value? Well, first of all, your earnings and principal were locked in at the end of year 1, so you experienced no losses. You also experienced no gains in the contract during that period, so you enjoyed a big fat goose egg on the earnings side. However, since you're not invested in a market-based investment where you incur market risk, this is actually a savings vehicle, your past principal and earnings are locked in. Now, in year 3, this is where it gets interesting. Your starting value is not at 1,100, but 800. So you have a new lower starting value. So you are now able to begin much earlier than you would have been had you been invested in a market-based investment where you had to recover past losses before you start enjoying future gains. So now your starting value is 800, and you enjoy a growth to 900. That represents a gain of 12.5% in your contract. So you enjoy another interest credit that year. And then finally, in year 4, your starting value is, again, the ending value for the previous year, and you enjoy a growth of 100 points, so that represents an 11% gain. Let me illustrate what I'm talking about in a graph. Now, this is a comparison of how you would have experienced both gains and losses depending on whether you were invested in a market-based investment where you incur losses over time, as opposed to an annuity where you experience none of those losses. Now, had you been invested in a portfolio that was representative of the S&P 500, you would have started in this example in 1998 with $100,000, and between 1998 and 2000, you would have enjoyed considerable growth in the contract. So your ending value in the year 2000 would be just under $140,000. However, as a result of the tech bubble, you would have experienced losses over the next 2 years, and so your ending value would have been just under $80,000. But then the market recovered and you experienced gains over the next several years. And so by the end of 2007, your ending value would have been just under $150,000. So you had managed to recover from the previous bear market and recover. But notice what happened in late 2007, early 2008. You would have once again experienced losses. So your ending value as of 2008 would be just over $110,000. Now, on the other hand, had you chosen the annuity option, your annuity would have grown the first 2 years, similar to that of a market-based investment. So your ending value at the end of 2000 would be just under $130,000. So you would not have enjoyed the type of growth that you would have enjoyed had you been invested in a market-based index with the S&P. On the other hand, during the years 2000 through 2002, when the market-based investor was losing money, your previous principal and gains in the contract were locked in. Now, you would have enjoyed no interest credits over that period, but you would have experienced no losses at the same time. You would have started enjoying interest credits while the person invested in the market was trying to recover. And so as a result, by the end of the year 2000, your account value would have been just over $160,000. And again, during the second downturn in the market, you would have experienced no losses. So where the market-based investor would have experienced an ending value of around $110,000, your ending value would be around $160,000 over that same period of time. Now, this is just another way of showing how adding an annuity to your portfolio can actually decrease your risk and potentially improve your results over time. And as you notice in the blue line represents your risk-reward efficient frontier. Now, this portfolio is comprised of 20% equities and 80% bonds. And so as you can see here, this person would have experienced gains and losses in the contract over the course of their life. And at the end of their life, their potential legacy value, that is to say the amount of money left in their estate when they passed away, would be roughly $135,000. Now, in the green example, what we've done here was we've taken half of the bond positions and we've substituted those with an annuity. So we're using an annuity as a surrogate for bonds in this example. And as you can see here, we've moved the line to the left. So we've actually taken risk out of the portfolio. And as a result, we've actually added an additional $86,000 potential dollars to the legacy value at the end of this person's life. So rather than leaving $135,000 to their heirs, they would have left roughly $222,000. That's just an example of using an annuity, adding an annuity to the portfolio to improve the results over time. That concludes our discussion of session 6 on options for income. During our next session, we're going to look at strategies for increase accounts. That is to say, accounts allocated for growth to keep up with cost of living. And we're going to ask several questions. First of all, how does segregating your money using the bucketing strategy for current incomes, how does that change the options available to you when investing for future growth? We're also going to look at the two schools of thought that we discussed just briefly during session 6, that is the tactical approach to investing, that is active management, versus long-term buy and hold or strategic asset allocation. And we're going to ask ourselves, how does this change the game in terms of investor psychology during periods of downturns? But we're also going to look at the importance of fees and ask ourselves, finally, what is a reasonable rate of return for money allocated to growth? And really, how much market risk can you afford to take? And then in session 8, we're going to conclude our boot camp with a discussion of strategies to increase net income as well as estate value by managing tax risk. We're going to look at hidden tax traps that could potentially reduce your income as well as your inheritance value. And then we're going to look at some effective strategies to lower taxes in the future. These include, again, some of the things that we discussed, like Social Security filing options. But we're also going to look at strategies that include a charitable giving component. So if you're inclined to want to contribute to your community and certain charities, you can actually use this to your advantage by what I call doing well by doing good. We're also going to look at some of the changes as a result of recent legislation, specifically the Secure Act of 2019 and its impact on both RMDs and stretch IRAs. And we're also going to look at Roth conversion strategies and investigate whether that makes sense in not only mitigating future taxes, but also improving both income as well as estate value. And if you're loath to continue taking RMDs, there are actually some options for you that will allow you to postpone RMDs on up to $125,000 of your IRA accounts. We'll look at that. And finally, we'll look at effective gifting strategies to leave a legacy after you're gone. And again, we're going to look at some ways to make lemonade out of lemon if you are required to take RMDs, but there are better ways to repurpose that money once you've taken the money out and paid taxes. And we're going to conclude our discussion by diffusing some of the potential tax bombs that your beneficiaries may face on your IRAs in their inheritance with what we call wealth replacement trusts. So again, thank you for your participation, and we will see you in the next session. Take care.